All right, everybody, welcome back to the podcast. My name is Ray Lucia Jr.
And I'm Joe Lucia.
And this is the Managing Your Financial Future podcast. A couple episodes back, we spent a great deal of time on our podcast talking about, remember the guy at the football game with the money, the gifting idea?
Yeah, we had a lot of fun with that. But there was one topic that came up, qualified charitable distribution.
Yeah, I mean, they touched on it just briefly. Qualified charitable distributions, QCDs for short. This is another financial planning strategy. To me, being a tax guy, it just makes sense. It's an opportunity for those who are charitably inclined to be able to take money out of their pre-tax retirement accounts, their IRA, and gift it to a qualified charitable organization and not pay any tax on it. If you just normally take money out of your IRA and then give that money to the church charity, it's going to increase your adjusted gross income, which has a potential domino effect to affecting your Social Security and Medicare and maybe even other things within your tax return. When you take money out and you use the QCD, it doesn't increase your adjusted gross income, and so therefore it's potentially a smarter way to gift money to charity. And so it comes to mind like when we go to church, right? And you look around and there's like 300 or 400 or 500 people in church, and they reach into their pocket and they're putting money out and they're putting in the gift basket.
Yeah, that was my favorite thing to do as a kid. I used to always, try to get a 20 for my dad. We got to put it in the basket.
Oh, no, I thought you were actually trying to put your hand in the basket and take the 20 out.
I've never made change, but I did see somebody do that one time. And I don't know how God looks at that. I guess it's okay if you had 100 and you only wanted to give 20 and you took 80 back. I think it's okay.
It's probably best just to keep your hands out of the basket. It's a one-way thing. You should just be putting money into the basket. But nonetheless, they're putting money after-tax dollars that's in their pocket already and putting it in the basket. And what's really cool about this concept of the QCD, here's a strategy that applies to almost virtually everybody who has an individual retirement account. They could take money instead of out of their pocket, which they've already paid taxes on, and instead take it out of their IRA pocket and gift it to charity.
And normally a distribution out of your IRA would be taxable as ordinary income, but in this case, in order to take a deduction of those after-tax contributions into the basket, you'd have to itemize.
Yeah, you got to itemize on your tax return, right? And since they changed the tax code, less and less people are even itemizing on their tax return anymore. So even though they're giving money, they're not getting really any tangible tax benefit for the gifting of that. However, if they reached into that IRA pocket and took money out of their IRA where otherwise it would have been taxable, like you said, as ordinary income, they don't have to pay taxes as ordinary income. It comes out without paying taxes. So it's tantamount to a deduction that doesn't really show up anywhere. They actually get the deduction whether they itemize or not.
And for those that are over 70 and a half that are forced to take the required minimum distribution, and they may not need the money, this is a great way for them to take those dollars.
That's another question we get all the time. I don't want to take money out of my IRA. I got this required minimum distribution. What should I do with it? I don't need the money, and it's just building up in my bank account, and I'm not spending it. Well, this is another great way. So you can get your required minimum distribution satisfied and gift the money. That's fantastic.
So to recap, if you're 70 and a half or know somebody who's 70 and a half and are charitably inclined, this is the podcast for you. So with that, let's throw it over to the guys, Johnny Dean and Rick the Professor Plum. Take it away.
It's been almost 2 decades we've been on this journey to educate, liberate, and help you take action so you may better manage your financial future, achieve peace of mind, and accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you set your goals and guide you along the way to help you achieve them. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. I'm your host, Johnny Dean, with our own Rick the Professor Plum, Chief Financial Planning Officer. 2 of us in studio, actually along with Ray Jr. and Joey. Thank you, guys. And thank you all for tuning in. Is that what you do for a podcast? You tune in? I mean, is this old hat, my broadcast career, tuning in?
Well, if you're saying it, it's old hat.
Exactly. Finding the dial, tune it in on your dial. Thanks for listening. We appreciate that. Download. You should subscribe, too. I don't tell people this often enough. Subscribe to our podcast. Most of you have who are listening, but some of you have just stumbled on it. We would love to have you as a long-term listener, and I think if the more subscribers you have, the higher you get on the iTunes list or something like that.
Okay.
So that's what I was told. Like I know these things. All right, so here's the deal with this is something that so many people just have never heard of. And to me, I see no reason under the right circumstances why somebody would not do this. Qualified charitable distributions, QCDs. How am I going to phrase this? Because people who don't understand what they are, let's start at the beginning, because otherwise it's not going to, my explanation is not going to make any sense. A qualified charitable distribution, Professor Plum, what does it do in 10 seconds?
It avoids the tax return, which means it doesn't affect a lot of things. Unfortunately, it's not easy. You take money directly from an IRA and send it directly to a charity. It does not go to your bank account. It's not distributed to you. It goes directly. Now, first is you have to be at least 70 and a half. So don't get excited about this if you're not 70 and a half yet. And I mean to the day. This isn't the year you turn 70 and a half like an RMD is. This is to the day or later that you're 70 and a half. But if you do so, you can take the money directly from the IRA and send it to a charity. And it no longer shows up on your tax return as part of your adjusted gross income. Now, the reality is most seniors are not itemizing their deductions. The charitable donation is an itemized deduction. So if I'm not somebody who has a mortgage anymore in retirement, I don't have a lot of property tax, state income tax, things of that nature.
You take the standard deduction.
I'm going to take the standard deduction, but I may be charitably inclined. I may give X amount of dollars to church, school, whatever, and I would like to get a deduction for that. But I'm not actually able to deduct it because I get the standard deduction. So I'm still going to give it, but it doesn't help me too much. But with the charitable donation, qualified charitable donation, it doesn't show up, distribution, it doesn't show up on the tax return. And you're saying, well, what is that really that big of a deal? And I say, yeah, it is, because the adjusted gross income, all the income goes together. Your qualified, your IRA distributions, your pensions, your capital gains, everything goes, and it creates your adjusted gross income. The higher that adjusted gross income is, potentially the more of your Social Security benefit will be taxed. So you've got to look at the interaction there. So even if I could deduct it, let's just make the numbers easy. I take a $10,000 distribution from my IRA. It raises my adjusted gross income from $40,000 to $50,000. I'm just making those numbers up. But then I get to deduct. So then it reduces it back down to 10 or back down to 40, right? It doesn't work that way. That $10,000 distribution from the IRA may raise my adjusted gross income by $18,500. And then if I get to deduct the $10,000, it reduces it by $10,000. My adjusted gross income still went up. My taxable income still went up by $8,500.
So here's the question everybody's asking. Wait a minute. And believe we're going to explain this in a second, okay? But if I have a $40,000 income for this year and I take a $10,000 IRA distribution, my AGI went from 40 to 50. What you're saying is...
Maybe not. My adjusted gross income includes my Social Security that's taxable, and so...
Well, that's what I'm saying.
Yeah.
That's what I'm saying. What you're saying is it could increase it not to 50, a $10,000 distribution from your IRA, yeah, it'll raise it to 50, but then it could also subject your Social Security.
Another $8,500 of my Social Security becomes taxable as well. So my income went up by $18,500 on that $10,000 distribution.
Well, my taxable income, my income actually didn't go up.
Yeah, no, because I gave it away.
Exactly. So, okay, so here's the deal. This is what we're talking about. When you're 70 and a half, you've got a required minimum distribution you got to take this out of your 401ks, your pre-tax accounts, your IRAs, etc. Now, we're going to talk about IRAs because you can't do this with a 401k.
Yeah, the qualified charitable distribution is only eligible from an IRA, traditional IRA. You cannot do this from a 401k or other qualified retirement plan.
Right. So here's what people do. Let's say they have a $10,000 required minimum distribution. I know people's are a lot less than that sometimes,
or a lot higher.
But let's just use 10,000. Okay, so I'm just your ordinary average person. I've got a $10,000 required minimum distribution because I'm 75 years old or something like that. And so during the course of the year, I find that I withdraw $10,000 from my IRA. I satisfy my required minimum distribution. So that goes away. All right. Now, I also, during the course of the year, like to give,
some money.
Let's say $10,000 a year normally. It just works out to my, my church.
And it doesn't have to be a one-time thing either.
No.
It could be a combination of my church, my school, my whatever charities that I want to give through during the year.
Right. But let's just say it's just a church. You write a check. You go to every week on Sunday and you write a check and you put it in the collection plate.
Yeah.
And at the end of the year, it totals $10,000, just to make it simple. All right? So I would look at this and say, well, okay, yeah, I took $10,000 required minimum distribution from my IRA because I was forced to. But on the other hand, I wrote $10,000 worth of checks to my church during the course of the 52-week year. So it's a wash, right?
Not necessarily.
Well, not necessarily. And that the not necessarily, it would be a reason why you should do the qualified charitable distribution instead.
Right. And the total income. So we had talked about the fact that $10,000 distribution could mess up your Social Security, could add a bunch more income to the tax return that wasn't there to begin with because the Social Security becomes taxable. But I'm 75 years old too. Maybe I have some medical expenses. That increase of $10,000 to my AGI, now $18,000 with the Social Security include, meant that $1,800 of my medical expenses are no longer deductible.
Right.
I mean, because you lose medical deductions the higher your adjusted gross income goes. Your adjusted gross income, you're single, and it goes over a certain threshold, $85,000. Now I get to pay more for my Medicare insurance down the line. So keeping income off of the tax return, even though I may be able to deduct some of it later, can be a very important tax planning strategy because not only does it affect the taxes that I may or may not have to pay on that RMD that came out, it may subject my Social Security to taxation. It may limit some of my itemized deductions for medical experience and things of that nature. It may increase my Medicare premiums. There's all these other things that can come about because of that increased income on my tax return.
Well, that's what happens. I like to look at your required minimum distribution oftentimes as making a giant footprint all over your... Remember the Monty Python foot that would come down? Remember? And smash
now
everything?
Now we're going back.
Right. There's an age thing for it. But it's the same kind of thing. It leaves a big mark and it can create havoc on your tax return. So the idea would be to keep that $10,000 required minimum distribution off of your tax return. Well, how can I do that if I'm required to take money out of my IRA as a required minimum distribution?
Well, we use this distribution, and now the qualified charitable distribution does not have to be the same amount as your RMD. It can be any amount of money you want, up to $100,000 in any given tax year. So if your required minimum distribution is $10,000, maybe I only use 1,000 of it to go to a charity. Well, that means 1,000 of it doesn't show up on the tax return. Maybe I do 50,000. It's more than the RMD, but it still doesn't show up on the tax return. So once I'm 70 and a half, if I'm going to be charitably inclined, and it's generally, you almost always have to be charitably inclined first before you do this, because otherwise
doesn't make sense.
You're not saving enough to offset what you gave away.
You are not. I saved $2,000 in taxes. Yeah, but I gave away $8,000 to the charity.
There are some instances where it does make sense, though. Even if you're not charitably inclined, if you're just over the Medicare IRMA threshold,
you can reduce
because if I just go over it, maybe I'm over it by $500 or so. So that means that my wife and I would end up paying another $1,200 or more a year in Medicare premiums. So if I gave $500 away on a QCD, I saved $1,200. Okay, that works, but that's a very rare instance.
It's a little wonky.
But hey, normally for any charitable donation to make sense, you do have to be charitably inclined.
Right. So the qualified charitable distribution, what it does is you direct direct your IRA custodian to take your required. Let's say you want
some dollar amount and send it to a charity.
I'm going to make this easy. I have a $10,000 required minimum distribution, and I want to I want to give all of it because I would, like in my example, I gave all $10,000 during the course of the year to the charity. So I'm going to tell look, rather than me write 52 checks a year, totaling $10,000 to my church, here it is in, let's say January. Mr. Custodian, take this $10,000 required minimum distribution, send the whole thing right now to my charity, my church, let's
Right.
say in this case. And so they will do that. It stays completely off my tax return. The church gets the $10,000 donation from me. I don't have to write a check every week now.
Yeah.
When I'm sitting in church.
But you do have to tell everybody around you. No, I've been
qualified
good. I made the donation.
Yes.
Don't look at me bad for not putting
exactly.
the donation.
Well,
in.
that's the only downside of that. Okay, so
now, the one thing is, now the IRA custodian, this is where people get trapped on this. The IRA custodian, when they issued the 1099 at the end of the year, they just issued the 1099 that $10,000 came out, normal distribution, as if they sent you the money. You do have to tell your tax preparer that you gave X amount of dollars as a QCD. Otherwise, if all you do is give your tax preparer the 1099s, they won't know, and the money will show up on the tax return.
Yes.
So tell either your tax program or tell your tax preparer that you did the QCD so that it stays off the tax return.
very important because they won't know. They don't.
Yeah, they don't know.
When money leaves the IRA, all they do is give you a 1099 and say, "All I know is money left."
And there is nothing on the 1099 from the IRA
That says where it went.
that says QCD.
Yeah,
It is,
so you have to account for it. But here's the final cool thing about doing qualified charitable distribution. In my example, $10,000. I would normally, put it on my tax return, then I would give it to the charity. Well, let's say that I don't itemize because the standard deduction, I'm a married couple and it's higher, right?
Right.
Well, I mean, I would have, under normal circumstances, that $10,000 coming in from the IRA, I write a check every week to my church. I can't deduct that.
Right.
I can't deduct that. Well, by satisfying my required minimum distribution through this QCD,
it never shows as taxable, so I don't have to deduct it. It's basically a deduction. It's a de facto.
deduction.
Yeah.
It's a de facto deduction in the sense that I never got the income,
I never had to pay tax on the income,
and the charity got the money. I just,
which is what I wanted in the first place.
so to me, Professor Plum, tell me if I'm wrong, but if I have a required minimum distribution of any kind, I don't care what it is. I have an RMD.
If I'm 70 and a half or older and I'm going to make charitable donations, I am going to do it directly from my IRA.
Why would you not? Even if your RMD is $20,000 and you only write $10 a week check or a month or whatever it is.
Doesn't matter the amount. The amount that you give through the QCD does not show up on the tax return. It does not affect the taxability of Social Security. It does not affect your Medicare premium. It does not affect your itemized deductions. It's a wonderful thing. There's no downside to it.
There isn't. There's no better way to do it. So I would say this for you people listening, who are admittedly you got to be at least age 70 and a half. What if you're a couple and one's 70 and a half and one's not? Does that?
Then the one that is 70 and a half can do it, and the one that's not cannot.
So it has to be in that person's name.
Right. I cannot make a qualified charitable distribution from my wife's IRA.
Right. Okay.
Just because I'm 70 and a half if she's not.
Okay, so there you go. But that aside, let's just say if you are over 70 and a half and you make any kind of charitable donations at all to wherever during the course of the year and you have a required minimum distribution, I guess I should throw in too that you don't really need the money because in many cases
you're going to make the charitable donation anyway.
Yeah, you're going to make the charitable donation anyway. Do it through a qualified charitable distribution.
Yep.
There's no reason not to.
I think it works right. And depending upon your IRA custodian, you can still set it up to go weekly, monthly, however you want to do it.
No, that's true. That's true.
Yeah.
The only thing is sitting in church and then having to pass the collection plate to somebody else.
You look like a deadbeat.
You look like a deadbeat. If you could just wear something that says "I gave at the at the IRA," I gave at Schwab or whatever, right? That would be interesting. All right, so that's called a qualified charitable distribution. I'm going to venture a guess that half, if not more, of the people listening had no idea what this was until we told them.
Age 70 and a half. If you're going to make a charitable donation, do it from your IRA.
IRA, that's right. 401k doesn't count. You got to have an IRA. But heck, why not? All right. This is all part of planning, by the way. This is one of the cool things about being a planner, as you are, which is you can tell people about this thing because people don't even think about it. They have no idea it even existed. It's one of those nice solutions to a problem that many people didn't even know they had.
And it's a way to say, you know what? You could cut down on those taxes that you're paying doing exactly what you're doing now.
You could get
changing the direction there.
Isn't that something? Small changes make a big difference.
Instead of the IRA sending you the money and having that money stop over in your checking account for a week before you give it to the charity, just send it to the charity.
Send it directly to the charity, right? It's like having your sloppy, lazy brother-in-law sleep on your couch for a week before he heads off to the Bahamas. Don't let him stay there. Just send him directly to the Bahamas because he's going to make a mess and you're going to be weeks and weeks cleaning up the mess. How's that? All right. I don't know where that came from.
One.
Well, it's one. I'm into analogies. I love it. A good analogy is like, I don't know, something. We are out of time. Hey, folks, if you want to know more about this stuff, not just qualified charitable distributions, but all aspects of planning, this is the great way you got to do it. You're not going to hear this anywhere else. You go to our website, luciacap.com. You can talk to Professor Plum, though. If you want to give him a call, 800-644-1150. The wonderful people at Lucia Capital Group, our sponsor, be very happy to talk to you about this stuff and tell you solutions to problems that you may not even knew that you had. That is potentially one of the great things. 800-644-1150. Okay, that's it. Managing your financial future for Professor Plum. I'm Johnny Dean. We will talk to you on this very podcast next time. Take care. The information provided should not be considered specific tax, legal, or investment advice. It is not intended or written and cannot be used for the purpose of avoiding penalties imposed by law. You should seek independent advice from a tax professional. This material was gathered from sources believed to be reliable. Its accuracy cannot be guaranteed. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy, including the investments purchased and or investment strategies devised by Lucia Capital Group, will be either suitable or profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. SSA website is at www.ssa.gov or call 800-772-1213 to speak with an SSA representative. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The investment professionals are registered representatives with, and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. Lucia Securities, LLC, was acquired by LPL Financial, August 2020. The investment professionals of Lucia Securities, LLC, are now affiliated with LPL Financial and are conducting business using the name Lucia Capital.